Ever wondered how Warren Buffett became one of the wealthiest people in the world? A man from humble beginnings, Buffett is the epitome of financial success. His name echoes in the corridors of Wall Street and Main Street alike, synonymous with shrewd investment and incredible wealth. But how did he get there? What's his secret sauce? Buffett's investment strategy is simple, yet profound. It's not about quick wins or short-term gains, it's a long-term play, a marathon, not a sprint. Buffett's approach is built on three fundamental rules that have stood the test of time and market volatility. The first rule, never lose money. This might sound a bit obvious, but it's harder to practice than you might think. It's not about never making a bad investment, rather it's about making sure that overall your investments are profitable. It's about risk management, about being cautious and thoughtful, about doing your homework before you put your money on the line. The second rule, never forget rule number 1. This underscores the importance of the first rule. It's a reminder that protecting your capital should always be your top priority. It's not enough to remember this rule, you must ingrain it into your investment philosophy. The third and final rule, invest in a business you understand. Buffett believes in sticking to what you know. If you don't understand it, don't invest in it. It's about being knowledgeable and informed, about making decisions based on facts and understanding, not on hype or speculation. These three rules may seem simple, but they require discipline, patience, and a keen understanding of the investment landscape. They are the pillars of Buffett's investment strategy, the guiding principles that have helped him amass a fortune. Now, let's dive deeper into each of these rules and see how you can apply them to your own investment strategy. In the coming scenes, we'll dissect each rule and explore how they can shape your approach to investing. So buckle up and get ready to learn from one of the greatest investors of all time. Rule number 1, never lose money. Sounds straightforward, right? But what does it really mean? Let's delve into it. In the world of finance, this principle is all about risk management. Imagine you're a ship's captain navigating through treacherous waters. Your primary goal is to avoid hitting any icebergs that could sink your vessel. The same goes for investing. Your main objective should be to steer clear of financial icebergs that could sink your financial ship. Consider this. If you invest $100 and lose 50%, you're left with $50. To get back to your original $100, you now need a 100% return, not just the 50% you lost. This is the power of loss, and it's why avoiding it is so crucial. Now you might be thinking, but we can't completely eliminate risk in investing, right? Absolutely correct. Investing inherently involves risk. However, the key is to manage and minimize it as much as possible. Think of it like wearing a seatbelt while driving. Wearing a seatbelt doesn't guarantee you won't get into an accident, but it significantly reduces the potential harm if you do. Similarly, risk management strategies in investing do not guarantee profits, but they significantly minimize potential losses. So, how do we manage risk? There are several ways. Diversification is one of them. By spreading your investments across different asset classes and sectors, you reduce the risk of a significant loss if one of them performs badly. Another method is thorough research. Before investing in any company, it's important to understand its financial health, competitive position, and future prospects. This can help you avoid investing in companies that are likely to lose money. Then there's the concept of margin of safety. This is the idea of investing in stocks when they are priced well below their intrinsic value. By doing this, you give yourself a cushion against potential losses. Remember, the goal is not to make a quick buck, but to grow your wealth steadily over time. This is where rule number 1 comes in. By minimizing losses, you keep your capital intact, allowing it to compound and grow over time. Even the Oracle of Omaha, Warren Buffett himself, has had his share of investment losses. But his focus on risk management and preservation of capital has helped him recover and continue to grow his wealth. So, the first rule of investing, according to Buffett, is to prioritize preserving your capital. That's rule number 1. It's not about avoiding risk entirely, but about managing it effectively to ensure your financial ship stays afloat and sails smoothly towards your financial goals. And remember, the journey of investing is a marathon, not a sprint. So keep your eyes on the horizon, stay patient, and keep rule number 1 in mind. Never lose money. Moving on to rule number 2, never forget rule number 1. This rule is a reinforcement of the first one. It's a gentle reminder, a nudge in the ribs, a signpost on your journey to investment success. Because, as the saying goes, those who cannot remember the past are condemned to repeat it. And in the world of investing, repeating past mistakes can be costly indeed. Let's take a moment to consider why it's so easy to forget rule number 1. In the throes of investment, it's easy to get swept up in the excitement of potential gains. The allure of those dazzling numbers, the possibility of your money multiplying, all of it can make you lose sight of the fundamental rule: never lose money. It's like being swept off your feet by a charming stranger only to forget that you're standing on the edge of a cliff. And it's not just beginners who fall into this trap. Even seasoned investors can get caught up in the thrill of the chase, the adrenaline rush of a risky venture. They start dreaming of enormous returns, and before they know it, they've thrown caution to the wind and forgotten all about rule number 1. But here's the thing. Forgetting rule number 1 is like forgetting to tie your shoelaces before a marathon. It's like forgetting to put on your seatbelt before hitting the road. It's a basic precaution that can save you a lot of pain and regret. So how do you ensure that you never forget rule number 1? Well, it's all about discipline and patience. It's about understanding that investing is not a sprint, but a marathon. It's about realizing that the tortoise really does beat the hare in the long run. It's about knowing when to hold back, when to wait, and when to leap. And most importantly, it's about understanding that no potential gain is worth the risk of a certain loss. It's about realizing that the purpose of investing is not to get rich quick, but to build wealth slowly and steadily over time. It's about acknowledging that the true secret to investment success is not daring, but caution. So take a moment right now to remind yourself of rule number 1. Write it down if you have to, put it on a sticky note and stick it on your computer screen, tattoo it on your forehead, if that's what it takes. Just make sure you never forget it. Because forgetting rule number 1 is like forgetting to breathe. It's like forgetting your own name. It's a fundamental error that can lead to catastrophic consequences. And that's why rule number 2 is so important. It's not just a reminder, it's a safeguard. It's a safety net that's there to catch you when you lose your balance. So there you have it, folks. Rule number 2, never forget rule number 1. It's the guardian of your investment journey, the lighthouse in the storm, the compass in the wilderness, and it's there to ensure that you always stay on the right path, that you always make the right decisions, and that you always protect your investments. Remembering rule number 1 helps you stay focused on protecting your investments. Now let's talk about rule number 3. Invest in a business you understand. This is a rule Warren Buffett holds dear, and it's one that could save you from making costly mistakes. Imagine walking into a casino and placing all your chips on a game you've never played before. Sounds risky, right? That's precisely what investing in a business you don't understand feels like. You're betting your hard-earned money on something you're not sure about, and that's a recipe for disaster. Let's consider the dot-com bubble of the late 90s. The internet was new and exciting, and investors were throwing money at any company with a .com in its name. But a lot of these businesses didn't have a clear business model, they didn't have a plan to make money. Many investors didn't understand the companies they were investing in, but they were caught up in the hype. And when the bubble burst, those investors lost big. On the other hand, let's look at a company like Coca-Cola. They've been around for over 100 years, selling essentially the same product. It's a simple business model that's easy to understand. They make drinks, sell them worldwide, and make a profit. Buffett has invested in Coca-Cola for decades. Why? Because he understands their business. Understanding a business doesn't mean you need to know every detail about how it operates, but you should have a solid grasp of its business model. How does the company make money? Who are its customers? What are its major costs? What factors could impact its profitability? These are the sort of questions you should be able to answer before you invest. Here's an easy way to test your understanding. Try explaining the business to someone who knows nothing about it. If you can explain it clearly and simply, you probably understand it well enough to invest. But what if you find a company that seems like a great investment but you don't fully understand its business? Well, you have two options. You can either learn about it until you do understand, or you can move on and find a business you do understand. There are plenty of fish in the sea, and there's no need to risk your money on something you're unsure about. Remember, investing is not about following trends or jumping on the hottest stock. It's about understanding what you're putting your money into. If you don't understand a business, you can't accurately judge its risks and potential rewards. You're flying blind, and that's not a position any investor wants to be in. So the third rule is all about making informed decisions. Don't invest in a business unless you understand how it makes money. This rule might seem simple, but it's incredibly powerful. It can help you avoid costly mistakes and make smarter, more confident investment decisions, and that's what successful investing is all about. So we've gone through the 3 rules, but why are they so important? Let's recap. Rule 1, never lose money. This is not just about avoiding financial loss, but more about the mindset of careful investment. It's all about investing in opportunities where the risk of loss is minimal. It's about doing your homework, understanding the risk, and making informed decisions. This rule is vital because it ensures that the capital you've worked hard to accumulate is not eroded by poor investment choices. Moving on to Rule 2, never forget rule number 1. This rule emphasizes the importance of the first rule. It underscores that the commitment to preserving your capital should never waver. It's a reminder that every investment decision you make should pass the no-loss litmus test. It's about being consistent in your investment approach, and that consistency is what can help you grow your wealth over time. Lastly, Rule 3, invest in a business you understand. This rule encourages you to invest in businesses that you are familiar with and understand. It's about making sure that you know what you're getting into. It's about using your knowledge to identify the value in a business and its potential for growth. This rule is crucial because it reduces the risk of making uninformed decisions and helps you choose investments that you can monitor and understand. So, why are these 3 rules so important? Well, they're the cornerstone of successful investing. They are the guiding principles that can help you navigate the often complex and uncertain world of investments. They are the tools that can help you identify the right opportunities, make informed decisions, and most importantly, safeguard your hard-earned money. These rules are not just about making money. They are about building wealth in a sustainable and responsible way. They are about ensuring that you are not just chasing quick profits, but building a solid financial foundation that can sustain you in the long term. For beginner investors, these rules can act as a roadmap. They can guide you in your investing journey, helping you avoid common pitfalls and make smart decisions. They can help you understand the value of patience, due diligence, and informed decision-making in investing. These rules can also help you develop the right mindset for investing. They can teach you the importance of being cautious, being consistent, and being knowledgeable. They can help you understand that investing is not just about making money, but about preserving and growing your wealth over time. So, there you have it. The importance of the 3 rules in successful investing. They may seem simple, but their impact can be profound. By understanding and applying these rules, you can navigate the world of investing with confidence and wisdom. By following these 3 simple rules, you can increase your chances of becoming a successful investor, just like Warren Buffett. So, there you have it, the 3 simple rules for investing according to Warren Buffett. These principles, while simple, carry the weight of decades of experience and success from one of the world's most successful investors. Rule 1, never losing money, might seem like a tall order at first glance, but it is a reminder to always prioritize risk management. Rule 2, never forgetting rule number 1, underscores the importance of this principle. Rule 3, investing in a business you understand, encourages us to make informed decisions based on knowledge rather than speculation. These rules are not a quick ticket to wealth, but a set of guiding principles to help you make wise investment decisions. So, whether you're just starting out or looking to refine your strategy, consider how you can incorporate these rules into your own investment journey. Remember, investing is a marathon, not a sprint. Take your time, follow the rules, and happy investing.